IndusInd Bank, India's fifth largest private bank with 42 million customers with a network of 3,000 branches, known as one of the most successful bank in India. But what if I told you that very same bank also became one of India's biggest banking disaster, losing over 80,000 crores in market capitalization, posting disastrous loss of 2,236 crores. At the center of all of this storm, a controversial CEO accused of insider trading. This is the story of IndusInd Bank and how it turned from most trusted bank to a wealth destroyer. IndusInd Bank makes majority of its money from interest. Let's say there is a guy called Abhijit. He is a businessman who has 1 crore. He deposits that money in the savings account at IndusInd Bank. Money deposited in saving account typically earn around 6% interest per year, which around 6 lakhs rupees. Now other person called Akash. He is a corporate employee and he want to buy brand new home, but he don't have enough money. But to buy a home, he need 1 crore. So he goes to the same bank for the loan. The bank agrees and gives him loan at the interest of 12% per year. So here is what happening. The bank pays Abhijit 6% interest per year because he deposited 1 crore in the bank. Bank earns 12% interest from Akash because he took 1 crore loan. That will be around 12 lakhs. That 6% difference is bank's profit, which is 6 lakhs. Now multiply this with millions of customers, lakhs of crores. Lot of money, right? But this is only one part of the bank's business. Bank also do different businesses like insurance, credit card, advisory and wealth management, broking and mutual fund, and forex trading. And this is where the storm begins. What IndusInd Bank doesn't realize that their own forex trading will turn into financial time bomb, and that's going to cost the bank a 2,100 crores.
IndusInd Bank shares crashed 20% in trade today as the bank reported discrepancies in its derivatives portfolio.
Coming in right now, IndusInd Bank has issued a clarification saying that the internal audit reported on microfinance discrepancies on May 8th, that they're saying that it was incorrectly recorded.
Bank runs forex business like this. In the US, the interest rate is just 3%. Let's say IndusInd Bank borrows $100,000 from NRI who's sitting in the US. Now bank only pays 3% interest just because interest rate in US is just 3%. But the biggest question here is, why do bank have to borrow money from US? Instead they could get money from Indian deposits, right? But look at this. If they borrow money from India, for Indian customers, they have to pay between 6 to 7.8% interest. But in US, the max interest rate is just 3%. So bank could make extra 9% if they borrow money from US depositors. Sounds good, right? But here is other big problem. That is currency fluctuation. When bank borrows $100,000 at the exchange rate of 82 rupees per dollar, they get 82 lakhs. Sounds good, right? But here is a twist. Because of high interest rates in US, dollar shot up 10%. Now $1 will become 90 rupees. To repay original $100,000 loan, now bank need 90 lakhs instead of 82 lakhs. Because dollar price shot up to 10%, right? That's an extra burden of 8.2 lakhs just because dollar became stronger against rupee. This is called currency risk and it could eat entire bank's profit. To protect bank's risk, bank follows a strategy called hedging. But what exactly this hedging means? Think like hedging is buying an insurance. Just like we buy insurance to protect our car or health, banks use hedging to protect itself from currency ups and downs. Let's say IndusInd Bank worried that the dollar might get the stronger in future. So to be safe, it goes to the forex market, enters into contract using derivatives. Here is the advantage of hedging. If the dollar price goes up, the bank will lose money when repaying the loan, right? But here is the catch. The hedge they did in the forex derivative contract, that will make equal profit they lost while repaying, and vice versa. If the dollar price goes down, the bank will gain on repayments and they lost money on forex derivative contract. In both the cases, profit or loss from the loan is completely balanced. So the currency movements doesn't affect the bank. This is how hedging makes the forex risk almost zero. So in the IndusInd Bank, they have two departments to manage this forex trades. One external treasury desk, internal assets liabilities management desk known as ALM desk. External treasury desk is responsible for forex transactions with outside parties like foreign banks or currency markets. They use forex derivatives like currency swaps. In simple words, it's a contract, just like we discussed before, to protect the bank from losses due to fluctuations in exchange rates. For example, if rupee becomes stronger or weaker unexpectedly, these contracts help the bank to avoid losses. And the other side, assets liability management desk known as ALM desk is responsible for bank's internal forex money flow, like how much foreign money bank has, how much it owns, and where the gaps are. They also use currency swaps but mostly balance the bank's internal foreign currency needs, like trades between ALM disk and treasury disk inside the bank. You could think of this like this: one part of the bank need dollars for loan, while other part has dollars from deposits. Make sure these needs are matched within the bank efficiently and safely. The external disk use the real market deals, which means losses or profits are visible mark to mark. That means if 1 rupee profit or loss happen, they get to know immediately. But when it comes to internal disk, the trades were not mark to market. They don't know what is current loss or profit immediately. This is where IndusInd Bank got into trouble. The bank was doing internal currency swaps, basically moving foreign money between its own departments. But the problem was these swaps not properly recorded the current market price. So the hidden loss keep building up silently because internal department doesn't know what is the current profit or loss. So hidden loss quietly building up silently until they became huge, almost 2000 crores in loss. But IndusInd Bank, known as the 5th largest private bank in India, right? How do they fail to recognize 2000 crores loss? Let me explain in a simple way. IndusInd ALM disk borrowed foreign currency in dollar and Japanese yen for long period, like 3 to 10 years. This foreign funds swapped into rupees internally with the treasury disk. But remember, internal swaps were not mark to market. Then around late 2024, the rupee started falling. The external treasury trades started showing big losses because they were mark to market. But internal desk, it's not M to M, so it does not showing any loss. This created a huge mismatch in the bank. Like one side of the bank is bleeding and other side pretending everything was fine because they don't know what actual loss is. But on the surface, a financial time bomb was ticking and no one noticed that. But everything came to spotlight after RBI released a circular in September 2023. That circular was RBI ordering all the banks to stop internal forex hedging deals. RBI also put a deadline till April 1st, 2024. By the time, IndusInd Bank was in big trouble because internal hidden swaps were exposed with huge loss, and that was impossible to hide. By November 2024, after internal reviews, IndusInd Bank management accepted that they made huge loss between 1500 to 2000 crores due to internal forex mismatch. But what happened next was even more surprising. Before even public doesn't even know what happening inside the bank, one top executive in IndusInd Bank quietly started selling his shares. He know the 2000 crores time bomb about to explode. That's why he started selling his shares before no one aware about it. That's not just unethical, that's illegal. It's called insider trading, and that's serious crime in India. Sumant Kapalia. He became the CEO of the IndusInd Bank on March 24, 2020. From the beginning, he appointed things was suspicious. In 2025, the bank's team requested the RBI to extend his tenure as a CEO for 3 more years. RBI strongly denies it and gives him only 1 year extension. At the same time, Kapalia have IndusInd Bank shares worth 134 crores. And suddenly he started selling his shares. Not few hundred or few thousands of shares, almost 9.5 lakh shares. This was before anyone know about the massive 2000 crores forex loss inside the bank. If he did that intentionally, that's called insider trading, and that's a crime in India. And when it's come to IndusInd Bank, the issue was not fraud, it was a mistake. It was internal trades made incorrectly. That's a system failure. But IndusInd Bank is still strong. It's not going to become next year's bank. But it's also big wake-up call for banks, because the biggest danger is not going to come from outside of the market. It might exist inside of the bank, even inside of its own balance sheet. This disaster costed the IndusInd Bank 80,000 crores loss in market capitalization. In January 2024, IndusInd Bank shares were flying at 1694 rupees per share, but by December 2024, the stock has crashed to 960 rupees, a fall nearly 43%. As investors watching this banking disaster, we need to learn 3 important lessons. Lesson number 1. It's really important to monitor the shareholders pattern every quarter. Look at this. When FII's most informed people started selling IndusInd Bank heavily, while retail investors started buying huge quantity, and that's a big red flag. So we should always track the promoters and FIIs, because they know things before we do. Lesson number 2. Rising stock doesn't mean that's an healthy company. IndusInd Bank stock hit 1694 rupees on January 2024. But behind the scenes, the big currency risk was building. By January 2025, the stock crashed to 960 rupees. So it's really important to diversify our portfolio. Never trust one company. And lesson number 3. Always follow management actions. Always look what top management telling in investors meeting. If they're selling stake but telling everything fine, it's a really red flag, and that's our chance to run out of the company. So yes, IndusInd Bank 2000 crores disaster was just happened because of forex swaps. It's not a fraud. It's about problem in corporate governance and risk management. That's what I like to tell for today. If you guys like my explanation, make sure you guys like and subscribe and hit on that bell icon. See you on the next video.